Hello, in this video we'll discuss tax practice and ethics. Now this is meant to be a basic introduction to the topic. This is something that we can have many videos on. You could take a whole course on tax practice and ethics, tax practice procedure, tax ethics, how to deal before the IRS, and professional issues. I've really broken it into 3 parts, and let's go ahead and get started. I want to note that even though there's going to be some slides, some presentation, certain things I'm going to cover more than others. So the first part deals with IRS organization, audit and examination, the process, as well as tax controversy. So first, let's look at the structure of the IRS. And this is currently at the time of this video. So at the top we have the commissioner. The commissioner, just like the treasurer, Secretary of Treasury, is appointed by the President of the United States. And the commissioner oversees everything in the IRS. Think of it like the CEO. There's various divisions: appeals, communications, compliance, chief counsel, national taxpayer advocate, statistics, operations support, and services and enforcement. Now, when we think about the IRS, what we're thinking about is the services and enforcement section of the IRS. Operations support provides internal support within the IRS to help with various issues. So you have chief financial officer, chief technology officer, human capital officer. Think of it like you got HR, you got various things like that. The services and enforcement section of the IRS is where we find all the different divisions when we think of the IRS. The agents, the collections officers. These are all within the services and enforcement. And it's broken into different groups: criminal investigation, Office of Professional Responsibility, Return Preparer Office, the Tax Exempt and Government Entities Office Division, Large Business International Division, Office of Online Services, Small Business and Self-Employed, Wage and Investment Division, and Whistleblower Office. Another division going back is the National Taxpayer Advocate. That's something I'm going to discuss in a bit because that is very important. So these different divisions really deal with the agents and collections of actually going out and determining whether there's a servicing issue. That's what the audit process is for, as well as the collections process. So the Wages and Investment Division deals with wages and investment income without preparation of paid tax return preparers. The Small Business and Self-Employed Division, really that's a big group, covers self-employed taxpayers, small businesses with assets in less than $10 million, and it also includes wealth transfer tax issues. And then Tax Exempt and Government Entities covers just those issues as you would think. Large Business International, this is the one that covers the big businesses: S corporations and partnerships exceeding 10 million, high net worth individuals, and C corporations. And it's also grouped into various industry categories. Now, Chief Counsel is not part of the service or collections. It's actually a legal advisor within the IRS. Chief Counsel is the group that actually helps write the regulations. So whenever you've heard me in previous discussions talk about regulations and the various pronouncements like revenue rulings, Rev Procs, Chief Counsel is the group that, well, they really have 2 functions. The first is the legislative function, which in Washington, D.C., you have Chief Counsel actually promulgating regulations on behalf of the commissioner. And again, other IRS pronouncements like Rev rulings or Rev Procs and private letter rulings. And then you have the second element of the Chief Counsel, which actually goes to tax court and helps with the litigation process. So Chief Counsel is the highest ranking legal advisor, and Chief Counsel is appointed by the President and reports to the Commissioner. Taxpayer Advocate Service, I mentioned that. This is something that directly reports to the Commissioner, and it's an independent organization. Just as the title suggests, it's to help with taxpayers and be an advocate for them within the IRS. We all think of the IRS as a very scary, intrusive organization, right? You think, okay, they're going to come to your door, they're going to knock on your door, they're going to get their money. Well, the taxpayer advocate is there to help taxpayers go through the IRS process. But they're an independent organization. Many times, they're seen as an unbiased party between the taxpayer and the IRS. Think of it like a mediator in some sense. Now, there's a National Taxpayer Advocate, which is in Washington, D.C., but there's also local taxpayer advocates that various taxpayers can go to, and they are responsible only to the National Taxpayer Advocate. And here's various jobs that the taxpayer advocate does. They resolve taxpayer problems and complaints. So it's all about customer service. Again, as I mentioned, we think about the IRS being very intrusive and whatnot. It's to really help with that reputation to make the IRS seem more customer service friendly. And if there are any issues, you have a party to go to. Think of it like a monopoly, right? The IRS is a monopoly when it comes to the government collections of revenue for the U.S. Who can you go and complain to? We could go through the court process, but that might take a long time. The taxpayer advocate can help you in some sense. It also offers IRS program for identity, organizational, procedural, or systemic problems requiring corrective action. So again, through that process. Think of it like the due process that we have in the Constitution within that organization. That's how I think of it. The taxpayer assistance order, so the taxpayer advocate may issue a TAO, that should be TAO, to suspend, delay, or stop actions by the IRS that would cause significant hardship on the taxpayer. And there's various types of hardship out there. Taxpayer can file a Form 911 to request relief. So the next thing is there's an Irs Oversight Board. And I want to be clear, the Irs Oversight Board is, yes, it's appointed by the president, but it's actually outside the IRS. Now, it has members on it, include the Treasury Secretary, IRS commissioners, but the idea is, if you think about like a corporation, the board of directors, many people on the board of directors are not employees of the corporation. They might be shareholders, but they are somewhat separate from the entity. They might be owners of it, but they're somewhat separate. That's the same idea behind the Irs Oversight Board. It's important because within Congress, there's actually, in the House of Representatives, there's an actual oversight board that deals with the IRS, but this is another type of oversight board as well. So there's lots of oversight, and again, it's all about, at one time, the IRS was seen as very intrusive, and you might be thinking it still is. I'm telling you right now, at one time, it was really bad. There's different protocols that have been put in place to help with that issue. So Taxpayer Bill of Rights, I recommend you look through it. It talks about taxpayer representation, right to record IRS interviews, explanation on disagreement, taxpayer. Again, this is about due process, attorney-client type confidentiality, innocent spouse rights, all those things. Please read about the Taxpayer Bill of Rights. Very important. Okay, the audit process. So there's different types of examinations that take place, but the question becomes, okay, well, how does the IRS get an issue, or how does an issue come up in a purely voluntary system? It's important to understand that the tax system in the United States is a voluntary system. You don't have someone coming to your door saying, you must pay your taxes right now. You don't have a tax collector coming around and taking the money from you. It's a voluntary system, meaning you file. Yes, there's going to be repercussions, and we're going to talk about those penalties and interest and all that stuff, but you actually file. That makes it voluntary. I know that some of you are thinking, how is it voluntary? It's not voluntary. I don't want to pay. Or your wages, it just is collected. But the idea is that you file every year, and it's a voluntary system. Now again, if you run the risk of not filing, you might not get caught, or you might get caught. That's the delineation there. If you do get caught, serious repercussions. So that's how we police that. Now, only a small number of returns get audited each year. I'm going to explain how exactly that's determined in a general sense. So the preliminary review of returns, so all business individual returns are reviewed for simple, obvious errors such as missing social security number, signatures. With technology and submitting online, e-filing, it makes it a lot easier. In the past, what would happen is you would have to paper file, and then the IRS would basically scan your returns, and it would go into a system. Automatic data processing deals with like matching. So let's say, for example, you're looking at an issue like alimony. So at the time of this video, alimony is included in gross income for the person that receives it, and the person that pays it gets a deduction. That might change in the future, but I just want to give you an example. You put the social security number of the party that you're paying it to, and then that party that receives it is supposed to include it. So by both returns having the Social Security number of the party receiving the alimony, it provides a matching system, a check system. If those don't match up, then guess what? It shows a red flag, and it brings attention to those two taxpayers. So that's really the matching system. All right, I talked about matches information on tax return. Another thing is W-2s, and with your wages. Your employer reports W-2s, they report that to the government, and then you report it as well. That a lot of times can create millions of discrepancies per year, and it needs to be fixed. And that's not seen as an audit. That's just seen as a correspondence saying, hey, these don't match up. The IRS sends you that. Now, there's also check returns for math errors and computation for tax due and whatnot, and that's something that the IRS does as well. Again, we have not yet gotten to the actual audit procedure. So some things are done at the IRS Service Centers, other things are not. So how exactly does the IRS determine who they're going to audit? And really the key is the discriminant function system. The discriminant function system, also known as DIF, is basically the secret formula that the IRS has. Like Coca-Cola, right? There's a secret formula of what exactly is in Coca-Cola. Well, that's like DIF. Discriminant function formula basically determines, it's a algorithmic system that's obviously based on technology, and there's certain things that score return and we don't know what those things are. It could be excessive compensation or a high amount of compensation versus deduction for a business versus how much income. It could be things like that. There's things that have been thought, but nobody actually knows the specific elements. Certain things as a percentage bring a higher risk or higher red flag percentage, and then basically the IRS looks at those percentages and says, okay, we're going to take the highest, and that's going to be who gets audited. That's usually what happens. Now, there's also other ways that the IRS just randomly selects, and that's the National Research Program. These are just randomly selected. So the DIF is based on a weighted scale of certain items, and the National Research Program is different. It's actually, it randomly audits, and it receives an extremely thorough audit. There's other selection methods, informants, maybe there's whistleblowers involved, and that creates an issue where, okay, someone says, I know this person has tax fraud, and that might create an issue. Again, to an element, there's random as well. I know the DIF system is a weighted system, but it's also some random systems. When I'm going to show you in 1 year what the percentage breakdown was, the chance of being audited for certain types of taxpayers, and you see that certain categories like estates greater than $10 million. At the time of this video, they have a higher chance of being audited just because there's not a lot. There's not a lot of those. So it comes down to numbers in a way. So this is in 2012. For individual income tax returns, overall, the chance of being audited is 1%. Now look at this. The next item says non-business return with income under $200,000. So that's no Schedule C, E, or F, or Form 2106, which is for unrelated business income. I'm sorry, not unrelated business income, for reimbursement of employee business expenses. That's really what it is. And that might actually be gone in the future with the change of the law. So again, this is in 2012, so this just gives you an idea. That goes down to 0.4%. You have a 0.4% chance of being audited. That's very, 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 very low if you don't have those items. Now, other things like non-business returns with income between $200,000 and $1 million, so higher income, 2.8% chance. And that's just a function of, okay, the higher you have income, the less people, and also the more types of itemized deductions you're taking and whatnot. Business returns without earned income tax credit, 1.2%. Business returns between $200,000 and $1 million, 3.7%. All returns, business and non-business of $1 million or more, 12% chance. See that? And these are individual returns, meaning on a 1040. So the business is dealing with, you're talking about 1040s with sole proprietorships and whatnot. Not talking about other, business entity forms like the 1120. That's next. So the corporate income tax returns a 1.6% chance. But look at this. This is really important. If you're a small corporation with $250,000 or less, under $250,000, sorry, you have less than a 1% chance of being audited. But if you're a large corporation with over $20 million total assets, you have a 93% chance of being audited. And a lot of the large corporations with over $20 million, they actually have an audit going on while the tax return is being filed. And I'll explain that in a bit. And then estate tax returns, a 30% chance of being audited because there's just not as many. Partnership tax returns, 0.5%. S corporation returns, 0.5% because there's so many. So the types of audits. There's correspondence examinations, office examinations, and field examinations. And there can be even virtual audits in the future. So correspondence examinations, these are the most common. These are just one or two items that are on a return or questioned. So you'll get an item in the mail that says, okay, your compensation deduction for your business just seems a little too high. We want to audit that amount. We want more information about that. And then you request documents. It's usually, the initial way is through the mail, but then after that, you usually will contact you through phone or whatnot. And you might actually have to come into a service center. Office examinations, the IRS, they come out to your office, and it basically is a full-on audit. It's a full-on audit. They look at all the items. Field examinations, this is where you have complex issues, where you have revenue agents coming out, multiple people. It's open-ended. They can look at anything again, and it's if you're looking at a continuum, the least intrusive would be the correspondence, and the most would be field examinations. So, as I mentioned earlier, some businesses that, as you saw, over $20 million in assets, they have a 93% chance of being audited. So businesses like Walmart and billion-dollar businesses, they have a 100% chance of being audited, and the IRS says, instead of just waiting for it to come out, what they do is they have an IRS office and agents that actually work with the taxpayer, Walmart, those big businesses, and they're actually looking at the information as it's being prepared. And they go out every year and they do various items and whatnot, and it happens. It's 100% guarantee, and it actually occurs throughout the process. Now, dealing with an auditor, the rules of professionalism obviously are important here. You can take a look at this slide to see, what's important, but it's important to be professional with an auditor. And you don't want to have, if an IRS auditor, if an IRS revenue agent comes to you and says they have some questions, you don't want to take a hostile approach. They can, be as professional as possible. They might only be looking at a few items, and they might not even look at other items. I'm not saying that you should be fraudulently, doing the other items or misrepresenting other items, but I'm just saying that it actually can lower the hours that you need to help your client with respect to an audit, and that's money that saves the client in the end. The client saves in the end. So after the audit takes place, the revenue agent prepares a report, the RAR, and then if the taxpayer disagrees, then what happens is a 30-day letter is issued. So I'm going to go back to these. This is my favorite part of this discussion. So when there's a disagreement with the findings, this is a great little chart, little tree. So when the disagreement of the findings, so we're starting from left to right. We have disagreement with findings, that's where the examination ends. Then the IRS response occurs, which is usually the 30 days, the 30-day letter. Finally, once that 30-day letter is issued, the taxpayer has some choice of actions. This is where you see this choice of things going. The taxpayer can just ignore it, and then finally, it will just go to a statutory notice of deficiency, also known as a 90-day letter, or the taxpayer can request appeals conference, and a written protest must be filed. And then you can actually do a disagreement with the findings, and that can also go to the appeals process or the 90-day letter. So let's go in the middle here. So it says request for appeals conference. Appeals conference. So if appeals conference takes place, that's before the 90-day letter is going to be issued if you decide to go that way. And basically that's the IRS is trying to, or they encourage appeals, which is kind of like a settlement process. If the IRS feels that they have a not so good argument, they might settle with you with some amount in the middle between what you think they should pay and what they think you should pay. Okay. Now, if that doesn't go well, so let's say after the appeals conference that it turns out that there's no agreement, then the 90-day notice of deficiency letter is issued, and that's where you have to determine what you want to do from there. So again, you have choice of action. You can not pay and go to the tax court, but you need the 90-day notice letter to do that. Or you can pay the tax and go to either U.S. District Court or Court of Claims. Now, anytime you can settle with the IRS, it's possible, up until the tax court rules or the U.S. District Court. And after the tax court or U.S. District Court rule, you can also go to appeals, to the U.S. Court of Appeals, where they might grant it or might not grant it, depending on the situation. All right? You get your appeal, and that's how it works. Okay, so I'm going to go back to the 30-day letter. So we're right here. If the taxpayer disagrees with the RAR, then the taxpayer receives a 30-day letter. If there's no response to that 30-day letter, then it's simply the 90-day letter, which that's known as the ticket to the tax court, because to go to the tax court, you don't need to pay, but to the other courts, you do. And then you sue for a refund. So here's an example of a 30-day letter. Again, this comes after the disagreement. If you accept our findings, please sign the consent form, or please consent to assessment and collection portion at the bottom of the report. Otherwise, we will bill you. If you do not accept our findings, you have 30 days from the day of this letter to do one of the following. It gives you, it's a due process letter. It tells you what you have to do. And the 90-day letter is very similar. It does a very similar thing. So look, if you're going to file a written protest to try to go to appeals, then you need some things here. I have them listed, the various things that you need to include in the formal written protests. So why should you appeal? Well, there's all sorts of reasons, but mainly the big reason is going through the legal process and going through courts costs a lot of time and money. And a lot of times you need to hire an attorney. You don't have to hire an attorney before a tax court. You can have a CPA or an enrolled agent that's passed various exams to go before the tax court, but it will cost you money, a bit of money. The IRS, they strongly encourage going through the appeals process, and a lot of practitioners do as well, because again, it can save you lots of time and money, and you might be able to get a more favorable decision than simply just paying the deficiency that the IRS is assessing. So the appeals office, basically appeals is a separate division. It's supposed to be not connected to agents or chief counsel, and really they look at your the facts, they look at your written protest letter, and they determine if they have a valid point. If you have valid points, then they might go more towards an amount that's better in line with what you want, and they view the hazards of litigation, which means the percentage of chance that they can they'll win, the cases out there and whatnot. So appeals conference can be informal or can be as formal as well. The appeals officer is supposed to be impartial, like a mediator or arbitrator or whatnot. And again, they have authority to settle on all factual and legal questions. And sometimes they do speak with the chief counsel, because they do want to make sure that if it does go to court, what chief counsel, what they think of the case. Okay, so if you decide that you don't want to go to appeals and you just want the 90-day letter, or you don't do anything when you get the 30-day letter, or 30-day letter doesn't work out, then you can just get the 90-day letter, which is the statutory notice of deficiency. This is the ticket to the tax court, because once you have this, you can petition the tax court, which is what many people do when they go to court. Not many people pay the tax and go and sue for a refund. Well, I mean, why would you? It's a time value of money thing, but also, what if you don't have the money and you think you're right? So here's what the 90-day letter says. It's kind of similar to the 30-day letter. It gives you some information. Basically says you have 90 days from the above mailing date of this letter to petition with the tax court, or you can pay and you can go before the U.S. District Court or the Federal Court of Claims. I'll explain why you might want to do that. So the real issue here is, why would you want to pick the U.S. District Court or Court of Federal Claims over the tax court? Because the tax court, you don't have to pay. Well, District Court is the only 3 courts that you potentially can have a jury. And if you have a very emotional issue, like a hardship issue, like you couldn't pay your tax, or penalty issue because of hardship, then having a jury can actually be to your favor. But most people go to the tax court just for the simple reason that they don't want to have to pay and sue for a refund. Another reason why you might go to the tax court is because tax court has judges that are technical with tax law. So that's all they do is they just deal with tax cases. Versus the federal court, federal district court, and the federal court of claims, U.S. Court of Federal Claims, that's not necessarily the case. Okay. Other reasons why you might pick the tax court over the district court or the Court of Federal Claims is there might be more favorable law in one or the other. Okay, the precedential value of the law that's involved, and it's more in your favor. All right. So I really talked about that. You can look at this even more about tax court, district court claims. Take a look at this slide. I'm not going to go too much into detail of that. That's more for a tax procedure course. So here's that little that roadmap, if you will. It's very important. It's very important that at a basic level, just to understand the process. So we have disagreement with the RAR, the 30-day letter, the appeals conference, the 90-day notice. Then you decide whether you're going to go to court or not go to court, right? And anytime during this, you can potentially settle with the IRS, or you can just pay the amount if you decide you change your mind. So there's reasons why, or we kind of talked about this already, why you might litigate. Again, if you have the money to pay for an attorney or someone to represent you. And also, by the way, tax court, very big on pro se. You can do pro se, which means you can represent yourself. But there's obvious risks to that. You don't know the evidence system. You don't know necessarily how to frame an argument, have witnesses or whatnot. Those are all big issues. But it can cost some money. Now, pro se taxpayers win 13% of their cases. Taxpayers represented by counsel represent or win 28% of their cases. That's obviously a big thing. The numbers are a little skewed there because a lot of the cases that go before tax court, a lot of times it's just easy that the IRS is going to win just because out of principle people just argue it. So I mean, if you do have a legit shot, you should always consider whether to litigate. And I recommend going and talking to a tax attorney or a CPA that's familiar with the tax court to see whether you have a valid argument, whether they think you actually should go through the process. And, picking or choosing that path might actually cause settlement in a more favorable way for you before the IRS. So closing agreements, they're formal, written, and binding. Basically, the taxpayer and IRS resolve the issue. Basically, this is at some point if you have a closing agreement. Offers and compromise, so again, at any point you can settle, and that's really what the offer and compromise comes from. And again, that's going to be an important document, and the IRS really encourages settlement through their process. So here you go again, more stuff about the offer and compromise. So it's really about settling the issue. Okay, so the next part deals with penalties, statute of limitations, and other procedural tax issues. So I'm not going to spend too much on this one because this one you can get really, really, really deep down in the weeds. This is just a basic discussion about these issues. So we're just going to talk about these basically. The first part is really important because it's important to understand the process of how you fit into things if you're a professional and where things go if something does happen with the audit and whatnot. And the role of the IRS and the role of the tax court and controversy and whatnot. So the purpose of penalties, again, as I mentioned, our system is a voluntary system, so it increases voluntary compliance. It raises revenue, so without political costs, you can get penalties and interest and whatnot. And there's other reasons, but those are the big ones. If we have a voluntary system, you have to have fines, penalties, and even criminal, possibly going, criminal sanctions, going to prison, jail, to basically scare people to make sure they actually comply with the law. So for civil penalties, there's really two types. Ad valorem penalties, which are percentage of the delinquent tax, and there's an accessible penalty, which is a flat dollar amount. Note that these penalties are not deductible when it comes to your taxes, in the future year, or when you're determining your tax for the year. The statutes really, they provide these specific penalties. There's so many different types out there, and you're going to see there's various ways that you can have exceptions, like reliance by IRS or a practitioner. We'll talk about some of these. So here's a list of the civil penalties, and we're going to talk about some of these. We're not going to talk about every single one, but these are the civil penalties, which most taxpayers and practitioners get hit with civil penalties. There are some criminal penalties, but one thing I want to be clear is that if you know anything about legal principles, when it comes to civil law or a civil case, civil procedure, when you have a civil legal case in front of you, it's preponderance of the evidence, which means more than 50% chance. More than 50% chance that it actually happened, or the person is liable or whatnot. When it comes to criminal, it's beyond a reasonable doubt, which is a very, very, very much higher chance. Some people have grouped it between 70 to 80% chance. So a lot of times the IRS will come, bring civil penalties at you because it's just a lot easier to argue a civil penalty than a criminal penalty. Sometimes they'll bring both civil and criminal penalties. So the first one is the failure to file a tax return. Now, at the time of this, it's a 5% of the amount of the tax due per month for a maximum of 25%. There's minimum penalties that apply and whatnot. Again, you need to look at this specifically on your own. So there's various reasonable cause, an action which would cause reasonable person under similar circumstances not to file. So there's certain reasonable causes that might excuse this penalty from occurring. So possibly reliance on advice of competent tax counsel, death, serious illness of a taxpayer or immediate family, destruction of taxpayers' home business records by casualty, various IRS issues. There's unacceptable excuses like no money to pay the tax, hospitalized but not due an incapacitating illness, incarceration, ignorance of laws. Those are not reasons you can use, and that's not reasonable cause. So continuing along with the failure to file a tax return, the burden of proof, presumption exists the IRS penalty assessment is correct. So basically, the burden of proof for showing reasonable cause is on the taxpayer, which, going back, showing reasonable cause, that's going to be on the taxpayer. The idea here is that the burden usually lies on the IRS to prove a penalty, but to prove a defense to that penalty is going to be usually on the taxpayer. And this is just a way to calculate for various business entities you can see on the slide. I'm not going to talk about that. So the next one is the failure to pay tax. So when does the failure to pay tax penalty apply? When a taxpayer fails to pay the tax owed in return without reasonable cause, or when the taxpayer fails to pay assessed deficiency within 10 days after notice and demand from the IRS. So we talked about some reasonable cause, how much that's there. Again, it changes. So make sure you look at that when you're actually looking at this video because it might have changed. When is the failure to pay tax penalty not applicable? When there's reasonable cause or when there's presumption of reasonable cause. So accuracy-related penalties. We're talking about overstating or understating your amounts. So 20% of tax underpayment attributable to negligence or disregard of applicable federal tax rules and regulations. So you just simply are negligent regarding rules and reporting something that you should have, or you over-reported or you reported a deduction you should not have. Substantial understatement, substantial overstatement, those kind of things. So that's 20%. So there's usually a 20%. That's the general, again, that might change, so you need to look at that, but that's the general one, a 20% penalty on the taxpayer. 40%, though, can apply to one or more undisclosed transactions that lack economic substance or failing to meet the requirements of any similar rule of law. So the idea here is economic substance is like it's done, the transaction is done simply for tax and it's not done for economic purposes. That's the idea. So in your mind, it's a lesser penalty, 20% versus 40%. And those numbers can change in the future. But it's a lesser penalty when you just simply have negligence versus a higher penalty when you have certain listed transactions and certain events that were just done just simply to save taxes. So what exactly is negligence? Negligence is any failure to make a reasonable attempt to comply with the provisions of the code. Now this can be waived if there's a good faith attempt to comply with tax law and there's also a full disclosure. Okay? And then the regulations state exactly negligence includes failure to keep adequate books, records, maintain substantiation, make reasonable attempt to determine correctness of deduction, those kind of things. Substantial understatement. So the substantial understatement rule, you can look at this here. I'm not going to go into it because it's very specific, but we're talking about understatement of like income, items that are obviously going to create more tax. And then obviously there's going to be substantial overstatement as well. We'll talk about that. This is a 40% underpayment of income tax penalty. We're still talking about substantial understatement. So there's an exception when penalty not applicable if there's substantial authority exists. And what is substantial authority? It's primary authority of a greater weight given to code sections or regulations over other administrative pronouncements. So if you understated something because you had substantial authority, then that can provide an exception to this penalty, this 20% penalty. Or where there's a reasonable basis for the tax return and the tax return position is disclosed, or it's considered a reasonable basis, and it has to be disclosed. So either you have one of two things. Either you have substantial authority, or you have a reasonable basis and it's disclosed. The return position is disclosed. So substantial authority is going to be a higher percentage chance. Some people have said substantial authority has been over 1/3, and then reasonable basis has been between 5% to 1/3. But the idea is that if you're going to do the reasonable basis, you have to disclose your position. This is the form, 8275 disclosure statement. So you disclose the item and how you came about getting that item. If you think, okay, it might be an understatement or a possible overstatement, you need to disclose that. Now, you don't have to disclose every single little item. If there's something that's an established rule of law, then you just simply do that. But if there's something that's a little bit more gray, you can use this statement. And again, if you have a reasonable basis and you disclosed it, then guess what? You have a defense to the penalty, the 20% penalty. The idea there, though, is if you do have a disclosure statement, this could potentially raise your chance of being audited. And also, if you are audited, you guarantee this is something that the IRS is going to look at, because even if you're audited, correspondence examinations, as we saw, might only look at one or two issues. If you have this and you're audited, you better believe the IRS is going to actually look at that issue, and that's going to be something they're going to want more information about. Overstatements, you're overstating deductions and things that are giving you benefits. That's what you have here. Very similar rules with respect to the understatement we just looked at, 20% and 40%. Estimated income tax payments. So it's important that you pay your estimated taxes. If you don't, you're going to have penalties and interest that you have to pay. So the idea is that certain taxpayers have to make estimated payments quarterly throughout the year. Usually you see this when someone doesn't have wages, but they have a business or they have investment income, and you have to calculate it. You have to make estimated payments. When you have wages, our current government system for taxes is that you have withholding taken out from your tax. This is very similar to what the estimated payments are. The estimated payments require you to make quarterly payments because the government wants their money in quarterly. You just don't pay it all at the end of the year. If you do not do your estimated payments quarterly and then you owe tax at the end of the year, you potentially could have penalties and interest you have to pay. So this is how we calculate it, and this is currently, it might change based on when you're looking at it. And again, there's penalties involved. Taxpayer civil penalties. So there's some other ones here. These are just, you can look at this slide right here, just gives you some of the general other ones, but we just looked at the big ones like understatement, overstatement, failure to file, failure to pay. Those are some of the bigger ones. Okay, criminal penalties. So as I mentioned earlier, the burden of proof is increased. It's higher. Okay, it's more than 50%. It's way more than 50%. Some people say beyond reasonable doubt is a much higher level. Usually you see criminal penalties involved when you have issues like fraud. That's usually where you see it. So it's usually limited to situations where additional tax will be collected from successful prosecution, crime committed for 3 consecutive years, or taxpayers' behavior is so flagrant that IRS almost assured of a conviction. And that last one is why fraud is such a big criminal issue. So here's the various types of criminal penalties out there. Willful attempt to evade tax, willful failure to collect remit tax, willful failure to file or pay estimated tax, willfully aiding and assisting fraud, willfully filing fraudulent information, disclosure or usage of return information. You can see some of the penalties. They range from $1,000 to $100,000, and then imprisonment of 1 to 5 years. That's pretty substantial. The IRS doesn't play around. Government doesn't play around. These are big things. And one thing I want to bring light to, if you remember from your history class, Al Capone, right? The FBI couldn't get him, but then on drugs and extortion and all those different criminal things, but they did get him on tax, and it was through the criminal tax law system. There's various defenses. Some successful ones include unreported income was offset by unreported deductions, unreported income was actually a gift, taxpayer confused or ignorant regarding applicable law, and relied on erroneous advice of competent tax advisor. So return preparers. So many of you watching are going to eventually prepare tax returns. You got to be careful. It's not just the taxpayer that can get in trouble, but also you as a preparer. So there's various penalties. They range from $50 to $1,000, and they're much more than that. And also, you can lose your license, you can go to prison, all those different types of things. The real issue here is, what exactly is a return preparer? And I'll just tell you that return preparer has been defined extremely broadly. Not only does it include attorneys and CPAs and enrolled agents that practice before the IRS that actually have done things on tax returns, but it actually includes even software providers, people that develop software. Those are considered return preparers because they actually create the code that does the actual return preparation. They've been held to be return preparers, and we're going to talk about that in Circular 230, the tax professions. Okay, it's very broad. You don't have to have any type of degree or certification. You don't have to be a authorized return preparer. You can be an unauthorized one as well. There's various penalties out there. $50 per occurrence for these items right here. Maximum of $25,000 per year per penalty. Lots of civil penalties out there. There's also criminal penalties as well. So the criminal penalties: aiding and abetting, aiding and assisting in preparation of false returns, disclosure or use of information, disclosure or use of return information for other purposes. Lots of criminal issues out there as well. An injunction. An injunction can be filed on you as a return preparer to stop doing your preparation. Again, you can have your license revoked, suspended, but then the IRS can say, you know what, you can't file any returns on behalf of taxpayers. Interest. So interest, in addition to penalties, interest can take place if you fail to file, failure to pay, those kind of things. It's a federally specified rate, the AFR, adjusted quarterly. It's compounded daily, so that's obviously a big thing if you know about finance and accounting. Compounding is huge, and when you compound daily, that can really add up. Statute of limitations. So statute of limitations is, okay, after a certain period of time, the IRS or the the government can't bring a claim against you. Well, generally the rule is that the tax must be assessed within 3 years, and 6 years though if it's admitted income that's greater than 25% of the income reported. So usually it's within 3 years. It has to be the tax has to be assessed, and that's part of the statute of limitations. However, there's no statute of limitations for fraudulent returns, so any fraud that's taking place, or failure to file. The IRS can request an extension regarding statute of limitations, and the collection. Collection has to take place within 10 years of assessment. If it doesn't, then again, statute of limitations issue. Now, suspension of statute of limitations, we call this tolling. We toll the statute of limitations for certain things. So remember in that process earlier on, where we saw the notice of deficiency, a 9-day letter, that can be tolled or suspended for up to 150 days. Then you can have a case in tax court that suspends. Offer and compromise, they suspend, and there's other reasons why the statute of limitations can be suspended. So suspended means, okay, towards that 3 years, towards that 6 years, the clock will stop ticking, and they'll continue after certain items have occurred. Mitigation of statute of limitations, you don't really need to, this is more of an advanced topic, but it really just deals with errors that were made and whatnot. With respect, the IRS might actually get an extension on the statute of limitations. Okay, so finally the last part 3, deals with certain IRS pronouncements, Circular 230, which is really important, and privileged communications. So we're talking about confidentiality. And then AICPA standards for tax services, I don't really want to spend too much time on, because really the Circular 230 is promulgated by the IRS, and that's very, very, very important. So first thing we're talking about is the IRS pronouncements. So letter rulings, private letter rulings, these can be issued specifically to a specific taxpayer, and they only apply to that taxpayer. They can only be relied on by that taxpayer. And it costs money. If you're a taxpayer and you have an issue, you can request a letter ruling, but it does cost money. There are certain issues that the IRS won't see, but they're limited. They're limited. So the ruling provides a written statement on the position of the IRS, and that once you request a ruling and the IRS rules, you have to follow that through. And better believe, if you file a private, letter ruling, a request for a letter ruling, you're pretty much sending up a red flag saying, hey, audit me, because they're going to make sure that you actually did you did treat the transaction the way that the IRS said you need to treat it. So again, as I mentioned, letter rulings can only be relied upon by the party requesting the ruling. These are generally followed by the IRS for the taxpayer who requested, so long as material facts of the transaction are accurately disclosed. So what they're saying is that, let's say you request a letter ruling and you change around the facts just a little bit. Well, the IRS will follow the ruling, even if it's the taxpayer's favor. But let's say that there was one fact that was changed around. The IRS can say, "Hey, that's not exactly what the letter ruling said, so we can actually go a different way." A fee is charged, as I mentioned. They're not applicable to other taxpayers. Determination letters. So these provide guidance regarding completed transaction when the issue involved is covered by a judicial or statutory authority, and they provide, again, completed. Private letter ruling, the transaction hasn't been completed, hasn't been filed yet for the tax year. The taxpayer is seeking advice. That's the distinguishing element. Determination letter, though, is after the fact. So determination letter usually happens like during an audit. The IRS is trying to determine how exactly to treat a transaction. Technical advice memorandum is issued by the National Office of IRS, to IRS personnel. So as I mentioned earlier, the Chief Counsel really has two functions. One is to deal with the IRS pronouncements in Washington, D.C., and the other is to actually go to court, the various tax court proceedings, or help Department of Justice and the U.S. Attorney's Office with cases in front of the District Court and the Court of Claims, Federal Court of Claims, or U.S. Court of Claims. That group that deals with the pronouncements actually issues this technical advice memorandum. So it's issued by the National Office to IRS personnel dealing with certain issues. Okay, so the next thing I want to talk about, and this is really important, Circular 230. So Circular 230 is really the IRS's, this is the main professional handbook, guidebook that you should use when you're practicing, when you're doing tax. And Circular 230 is the broadest measure of tax professionals. As I was saying earlier, a tax professional, a preparer, is defined very, very, very broadly. And Circular 230 does just that. So generally, practice before the IRS is limited to CPAs, attorneys, and enrolled agents. In limited situations, other parties may be allowed to practice for the IRS. You can do a pro se case, again, at tax court, but you can also go at an appeals. Various officers are all listed here. But the real thing to pay attention to is that the IRS requires that all paid tax return preparers, including CPAs and attorneys, obtain a Preparer Tax Identification Number. It's called PTIN, before they assist taxpayers with returns for a new filing season. The IRS may use the PTIN data to identify preparers who commit a pattern of errors or who participate in fraudulent actions. The idea is that if you have a PTIN, the IRS has a lot of regulation over you. But they also have, through Circular 230, regulation over those that don't have PTINs as well. They're just tax preparers. Okay? Because you might not be an enrolled agent or a CPA or an attorney, and you might be actually preparing returns. I'll give you some examples in a moment. So Circular 230 also contains requirements to disclose non-frivolous tax return positions. So we talked about that earlier. Inform clients of penalties likely to apply. Make known to clients any error or omission the client may have made. Submit records lawfully requested by the IRS. So it also contains requirements to exercise due diligence and use best practices in preparing. It's not unreasonably delayed disposition of matters for the IRS, and represent clients of conflicting. Can't represent clients with conflicting interests and whatnot. That the definition of a tax return preparer or tax professional as regulated by Circular 230 is very broad. It even includes the professionals that develop software like TurboTax and H&R Block software and whatnot that don't even practice tax. They're just computer coders. They actually deal with the tax law, and that's part of the Circular 230 is to regulate or to have a broad overview of those people. Now, if you have a PTIN, the IRS through Circular 230 has very extensive ways to control what you're doing and look at what you're doing. But if you don't, that's what the IRS is trying to get at. They're trying to get at these unregulated return professionals that are still regulated, that are still under Circular 230. And that's a huge issue right now. So privileged communications. So one thing to note is that attorneys and attorney-client privilege is the most broadest confidentiality out there. It covers criminal. It covers all different things. non-tax legal issues, but a CPA and a client through CPA client confidentiality can also have confidential issues protected as well. Again, it's not as broad though as the attorney-client confidentiality is, and that's one reason why some clients prefer the attorney-client confidentiality, and they prefer to have an attorney doing their taxes over an accountant, because you buy that more broad coverage of confidentiality. So the last thing I want to talk about briefly is just the AICPA standards for tax services. This is important, but it's not near as important as Circular 230. So statement number 1 deals with tax return positions. So you please look through that statement. Statement 2, questions on returns. Statement 3, procedural aspects of preparing returns. Statement 4, estimates. Statement 5, recognition of administrative proceeding or court decision. Statement 6, knowledge of error. Statement 7, advice to clients. Now this really finishes up the basic introduction to tax practice and tax ethics, but I want to advise you that this is something that you probably should go even further on. This is just giving you just a general idea of what to know, but this hopefully will open up issues that you can explore further, so that you know, because if you are going to be a tax professional, you need to know these issues thoroughly, especially if you're a CPA, so you know, okay, well, how far can I go in terms of the practice of law? Or if you're an attorney, okay, well, how exactly am I regulated by, these AICPA rules, which is, I mean, as an attorney, you're not necessarily, but these general provisions might actually be argued, against an attorney, because you are still practicing as a tax professional. All right, so I hope you enjoyed this.